Welcome to the latest Motley Fool scoreboard. I'm Anand Chakavalu, and we've got longtime fools Lou Whiteman and Travis Hoyam giving a 1 to 10 rating to a company that's betting on Vegas. It's Vici Properties, ticker symbol VICI. Talk about the business first, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Lou's at an 8. Travis, you're at a 6.
Yeah, I mean, this is a fine REIT company, but the risks are not really about gambling. I think that's what's interesting about Vici today. You know, even a few years ago, you would say we got to watch the operations in Las Vegas, but Las Vegas is actually doing really well today compared to pre-pandemic. Now, they had obviously some turbulence during the pandemic, but they've got plenty of money to pay their rent. That's ultimately what Vici wants. So at the end of the day, this is really more of an interest rate risk. So that's why I just didn't go particularly high here. But if you're into REITs, this is actually a pretty good one to consider, because I think the underlying operations of the companies that are actually paying their rents are pretty good.
Yeah, I'm glass half full for the exact same reason. I mean, you know, I like Vici because I don't like really investing in the gaming industry, but I do believe in Vegas. And, you know, the gaming companies, they've been kind of boom bust. The marquee properties and the land underneath it, they don't go away. Vici is the largest landowner in Vegas, has good diversification with properties all over the U.S. and ultra long-term leases on some of these best properties. Yes, there's interest rate risk with any REIT, but I think they're pretty well managed. They do kind of get hit by slowing traffic in Vegas, so they're not immune to trends. But for me, this is the way to invest in Las Vegas, not the gamers. And I'm pretty high on it.
For management, a 10 is Warren Buffett. A 1 is Homer Simpson. Once again, Lou's at an 8. Travis, you're at a 6.
Yeah, I can't get past the founding of Vici, which actually came out of Caesars, half of Caesars, the bad Caesars, if you will, going bankrupt almost a decade ago. Very strange situation. I wrote about it a lot at the time. But the founding CEO was the CEO that came out of that restructuring. So I just don't like a lot of kind of the back and forth that happened at that period of time. And in addition to that, I think they bought very high when they bought a lot of MGM's properties. MGM had their own REIT. Vici came out of Caesars. So those two combined, that's why they're the dominant player in Las Vegas today. But I think they really bought high with a lot of these, and that could come back to bite them long term.
You see, I disagree there. I think they timed the market pretty well, because they were buying when money was free, you know, when basically rates were zero, and that's when you want to expand. I also think that not only did they take advantage of that, but they have executed on those deals pretty well. I think they've integrated. That's what we want to see. We want them to be opportunistic acquirers, and then to manage what they acquire. CEOs and Ed Pitonick, you know, they've gotten bigger without wrecking balance sheet. They've managed what they have. That's kind of a gold star for me. So yeah, I'm at an 8.
All right, for financials, a 10 is a fortress, a 1 is yikes. They've gone for 8 and 6 and averaged to 7. This time they both said, all right, fine. We'll meet in the middle. Both of you have 7s, Travis.
Yeah, the financials are fine for a REIT. They are profitable. They're paying a nice dividend yield at 5.5% at this point. And I'm not worried about the revenue from the casinos. I think that's one of the things with REITs is you got to look at, is the underlying business fundamentally strong? I think it is, especially with the growth that we've had over the past decade or so from when a lot of these original leases were signed. But they do have a lot of debt maturing over the next few years. And, you know, there's a long runway on 16 or $17 billion worth of debt. But 1.3 billion this year, 1.8 next year, 1.5 the year after. They also have some variable interest debt. So that interest expense is going to go up, and I think that's going to go up faster than you're going to see their rent increases, which are actually capped by contract. So that's going to sort of put some headwinds on the potential yield growth for the company long term, and not a lot more assets that they could buy either.
Yeah. So, you know, this is a net lease REIT. You're going to see a lot of debt, and there is a ton of debt. That's just kind of the way they operate. So yeah, there is risk. Travis is right. But by industry standards, I think the balance sheet looks okay. Note they have an investment grade rating with all 3 agencies, which I think is important. Barely, but they are investment grade. Yeah, there's refinancing risk, but they get to refinance as investment grade. There was sluggish growth in the most recent quarter. And in general, there are natural limits to these REITs. I think Travis is right. I don't think there's a lot of like obvious growth from here right now. The investments are for everyone, but I think the balance sheet is better than fine. So a 7.
Lou, let's talk valuation. How well will Vici Properties stock do over the next 5 years? How safe is it? 10's a sure thing, 1's a lottery ticket.
So as Travis said, there's a question of, is the dividend sustainable? I think it is. And you get to start out here with a 5.45% dividend yield, which goes a long way towards that total return of about 10 to 15%. I think they can do it. So, I don't think this is a big grower. I don't think they're going to be as acquisitive as they were. I think it's more just digest and own what they are. But I do think with that dividend yield, the total return looks pretty good as a market beater. For safety, I'm at a 6. Might be a little conservative here, but as Travis said, there are scenarios where a downturn and having to refinance where I don't think the company's in trouble, but the dividend could be in trouble, and that would ruin your returns. I don't worry about the company going under, but you could lose money from here if things don't work out.
Yeah, I agree with everything that Lou just said. And that interest rate risk is what I would be concerned about. And, falling cash flow as a result. That's why I set my expectations a little lower at 5 to 10%. Maybe you get up to the high end of that, so you get a little bit of appreciation in the stock or the dividend over time. But I would say just count on that dividend yield, and if that's enough for you, this can be a phenomenal investment.
Time for everyone's favorite. Top it. Lou, is there a company in VICI Properties space that you like better?
So not really. As I said, I really don't like the casinos. I just don't like the nature of them as far as an investor. It's not a moral thing. And I am not as big a fan as EPR Properties as some are in Fool Land. So if you want this so-called experiential REIT, I think this is the best choice, at least for me.
Lou's talking to Jason Hall, I think.
Yeah, I am. Or Frankel, all these guys.
Or Matt Frankel, yeah.
Yeah, and I'm going to go the opposite direction. MGM is one of my favorite stocks. Extremely cheap. They're buying back about 15% of their stock on an annualized basis. They've got growth potential, not only in Las Vegas, just a little bit of growth there, but Macau is still recovering. And then we got this Japan casino, a $10 billion casino coming down the pipeline. You may get more yield just from the buyback with MGM than you would with VICI.
Thanks to both Travis and to Lou. They've given VICI Properties a decent overall score of 6.7 out of 10. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Viva Systems. Till then, Fool on.
Stop recording. But
Stop recording.
but